Good afternoon, everybody. Thanks so much for joining. We're just going to take another 60 seconds to allow any stragglers to join before we get started. So just sit tight for a little bit here and we'll get going momentarily. All righty, we're almost at 4:02. So good afternoon, everybody, and thank you so much for joining to take the time to hear from us today. For those who I haven't met, my name is Daniel Dusina. I'm the Chief Investment Officer here at Blue Chip Partners, and I'm joined by Matt Mondoux, Partner and Senior Financial Advisor here at Blue Chip Partners. Before I forget, I want to let everyone know that we have received a few questions between when we announced the invite to this and now. But if you have not submitted any of your questions, you can feel free to do so throughout our prepared remarks using the question functionality on the application. And we'll look to leave and address all the questions that we've received until the end, but don't hesitate to fire them in as we're speaking. So just to set the stage, Matt and I are here today for you guys. That's why I'm encouraging everyone to ask questions. We want to make this as beneficial and productive for anybody that's joining or listening to the recording hereafter. What Matt and I have set out to do today is really three specific things. Now, Matt's going to start off by talking a little bit about, at a very high level, what are tariffs, how are they going to impact companies both domestically and abroad, and really just provide somewhat of a tariff 101, if you will, because even though these became in vogue from a terminology perspective in 2018 and are again today in 2025, I do still think there is a relative level of just unknown around what these things are and how they can impact domestic companies. Next, Matt will walk through a little bit of context with regards to market sell-offs, what that can mean for today, how we should be thinking about the shape of financial markets today. And then I'll close with some recommendations. And really, I would say that these recommendations are very much client and individual dependent, meaning I think it's going to be very important for you folks that are dialed in to talk to your individual advisor. Do not hesitate to reach out to whoever you work with at Blue Chip Partners, whatever the question may be, whatever the concern may be, we're all here to help you. So with that, I'm going to turn things over to Matt, who's going to start off with a little bit of a 101 on tariffs.
Yeah, thanks, Daniel. I appreciate it. So first slide here, we're not going to get too detailed into because at this point I think everyone probably has a fair idea what happened on April 2nd. We know that the administration announced tariffs against a whole host of countries across the globe, which impacted financial markets, which ultimately brings us here today. But taking a half step back, let's talk a little bit about what tariffs are. In a nutshell, tariffs are extra costs that companies have to pay when they bring goods into the United States from other countries. Tariffs can affect companies in five major ways. Number one is going to be higher prices. So if there's parts or materials or components of a finished product, and those are brought from outside the country into the country, there's going to be tariffs associated with those. Finished goods from outside the country brought into the country, there'll be tariffs associated with those. Companies, as a result, may have to raise the price of these products, which can ultimately, and one of the fears being, lead to higher prices borne by consumers. On the other hand, companies could choose to make less money. So what they could choose to do is allow the tariff to eat into their profit margin, so the percentage of profits that they make on each good. They could allow the tariff to cut into their profits. And for shareholders of companies, that necessarily wouldn't be a great thing either. Less profits means, all else being equal, can mean lower share price. Now, companies also have the ability to react. So companies can change where they get stuff from. One of the dominoes that we could potentially see fall is as tariff rates are negotiated between the US and other countries, some countries may opt for a friendlier stance while some a more restrictive stance. You could see manufacturing or companies move manufacturing to areas where countries have negotiated a better tariff deal for themselves if manufacturing is still going to remain outside the US. So that's a potential option. Potentially too, firms could choose to bring manufacturing back into the US so they can take the time, set up factories, and actually hire and build things here. That's another option that some companies will undoubtedly explore, but can take some lead time, and there might not be an immediacy to resolve the price hikes at this time. Now, there's going to be other companies that this will be good news for, right? So not all companies are hurt by tariffs. Some companies, just make things in the U.S. I think the great example would be like the utility sector. The utility sector is domestically focused. They have been, the recipient of some flows of funds. Their stock prices have done well, relative to the rest of the market. And that's something that we've seen, and tariffs aren't going to necessarily have the same impact on utility companies that they will a clothing manufacturer. But the big issue here, though, that companies face is uncertainty. So when there's a lot of tariffs announced, things can feel really uncertain. They feel uncertain for investors, and likewise, they're going to feel somewhat uncertain for the individuals, the C-suite, the CEOs that run these companies. It can be difficult to figure out, which tariffs are going to stick, which may be negotiated down. Should I move a factory? Is it going to make sense to move a factory? There's an investment there. So uncertainty ends up being what markets and investors dislike the most, and I'm sure CEOs feel the same way. A great example of some of the volatility, uncertainty that we've been witnessing over the past couple of days is actually in a company, Nike. So on Friday, after the initial impact of the market reaction on Thursday, the markets opened down on Friday. Nike was down somewhere in the neighborhood of 10% at one point during the day. And then there was a news headline released about Vietnam, interested to lower their tariffs with the US to 0%. And that showed the investing public that Vietnam was willing to, potentially work with the administration on lowering their tariffs. And you can see on this slide here, Vietnam had, one of the highest tariff rates that was proposed. So Nike went from nearly down 10% to positive 3% on a day when the markets finished down over 5% on Friday. Nike finished at positive 3%. So this intraday volatility was due to a favorable headline that occurred midday from Vietnam's reaction to the tariffs, which I find very interesting, and it shows how difficult it can be to try to time the market and even time specific companies during heightened periods of volatility. International sales end up representing about 30% of the money made by companies in the S&P 500. So they are not only selling goods internally in this country, but also externally as well. And again, adding to the uncertainty of just the tariff announcement is other countries' reaction to tariffs. And obviously companies that have more exposure to international revenue are more exposed to retaliatory tariffs by other countries. There are certain sectors and companies that are more at risk of reciprocal tariffs. So for example, the technology sector you've probably seen has struggled. Technology sector is one sector. Companies such as Apple, Microsoft, these companies get a large percentage of revenue internationally. They could be subject to increased tariff rates on their products outside of this country. Materials companies like a Dow Chemical falls into this bucket. Communication services companies, think of Google, they would also fall into this bucket. And even companies, more consumer staple type companies like a Procter & Gamble or energy, all of these types of businesses do tend to get more of their revenue from overseas. Not more relative to their US revenue, but more relative to other companies within the S&P. So Daniel, if you go to the next slide, this is a great chart. This is the stocks, the S&P 500 index, going all the way back to the Great Depression. And this is a tremendous context here, the ups and downs, the various crises, panics that we've witnessed in the market, starting with the crash in 1929, the Great Depression. There's been various wars, whether it be World War II, Vietnam War. We've had Black Monday, the stagflation of the 1970s, 1980s, the tech bubble, the housing crisis, the pandemic, and all the way up to today. And the long-term market outlook, despite these immediate reactions of the tariffs that, frankly, the impact remains a little uncertain at this point. Markets have always faced challenges in the past, and they bounce back. Warren Buffett, was even noted that even after major global crises, U.S. markets thrive. It's important to remind yourself that we've made it through various times that are undoubtedly, we'll look back, probably more difficult than today. And we've made it out the other side. Like I said, the more it's important to recognize that CEOs can react, they can adjust supply chain. Sure, there's a cost, but there are intelligent individuals working on this and trying to figure out a way to make money, because at the end of the day, that's why they're running their businesses, and that's why we invest in blue chip quality businesses. So Daniel, with that, I'll throw it over your way to cover your portion.
Yeah, thanks, Matt. I thought that was really, really good insight with regards to tariffs, and then also just the idea of stepping back, looking at market returns in context, I think is really important, because what I'm about to talk through and what I'm showing on the screen right now, it basically comes at our recommendations, or it comes at your potential paths of action from the perspective of what do my actions today have the potential to do for my long-term returns. And I think the way that this graphic is set up, I think is really, really interesting and powerful. Shout out to our analyst, Vince Perrick, who helps out Matt and I on the investment committee behind the scenes. But this pyramid basically shows you at the base of the pyramid, small actions that have low probability of you regretting them in the future, all the way up to the top of the pyramid, which shows more drastic actions that could be taken today that have a much higher likelihood of you regretting them in the future. And this is all in light of the chart that Matt just showed. We have seen so many periods in the past, as recently as 2022, a year when both stocks and bonds were meaningfully negative, a year as recently as 2020, in which the market drew down 30+% before finishing the year positive 18%. The point being, whatever decision you make today can have an impact on how the next 5 years, 10 years, 15 years look for you. And that's not to scare any of you, it's just for you to keep in mind the decisions that you make today do have a long-term impact. So whether that's at the very base of this period, small actions like perhaps satisfying a bigger portion of your portfolio towards short-term cash needs. If you have right now 12 months of living expenses or cash needs allocated to actual liquid assets, maybe you take that to 2 years instead of just 1. This is a small action, a very minor likelihood of you regretting that in the future. If you move up through the pyramid, some of these more moderate actions, such as a slight target asset allocation shift, going from an 80% stock market target down to 70 or 60%, increasing bond exposure at the same time, that has a more moderate impact in terms of the potential for you to regret that in the future, just because, like the chart that Matt showed, you are most likely giving up long-term future potential return. As you move to the very top of this pyramid, more drastic actions, just plain and simple, have a higher likelihood of you regretting it in the future just due to opportunity costs. Drastic actions like pulling out of the stock market entirely, understanding that right now things are a bit uncertain. I'm sure individuals are nervous. and it can be an emotional time just in general, especially for those folks who are at or near or in retirement. That said, these drastic actions do have the ability or the potential to make a meaningful impact on the downside to portfolio returns over the long term. Because just as quickly as markets drew down 5% on both Thursday and Friday, because of the level of uncertainty and the rapid pace that information is developing, there is serious potential for us to see some of the best days after these worst days that we've seen. And so the recommendations that we have are very much individualized, as I mentioned at the onset. And at the very, very, I would say, highest levels, the recommendation we have is stick to your plan. If your financial plan works right now, then realistically, we don't need to make those drastic changes that were shown at the top of the pyramid in red. I would say have a dialogue with your advisor. We have the ability to shock your financial plans, make assumptions that would be a worse than worst case scenario, whatever will help you feel comfortable, we're happy to do. But realistically, what we've talked about through this presentation and most likely with you at various points in the past is that investors rarely benefit from knee-jerk reactions. Long-term investors that stick to the plan have generally had it work out for them in the long term. And that's why we would say that sticking to the plan is our base recommendation. That being said, we understand that right now there are a lot of challenges that people are working through. So if you do feel compelled, if it will help you sleep easier at night to beef up your cash allocation, completely understandable. What I would say is that if you look at the chart on the bottom of this screen, what it's showing you is over the last 25 years, what the return impact on a $1,000 initial investment would have been if you exited the market, the stock market in the US completely for the various periods shown. And the reason that you see such a stark difference between the green bar, which is an example of someone that was fully invested over that 25-year period with the $1,000 starting amount, and just being out of the market for 1 week, it goes back to what I said just a few minutes ago with regards to when we see these very volatile times and see extreme drawdowns intraday, most of the time what we end up seeing is there is severe upside volatility as well that follows soon thereafter. And it's not to say that it's going to be a straight line back to all-time highs for the market, but this just helps paint the picture of volatility and uncertainty do exist, and it kind of cuts both ways. You know, an analogy that we like to use often with clients, prospects, and just in conversation is that if you are driving to Florida, you can get there in a number of different ways. Technically, you could take side streets the whole way. You could also take the highway and go 120 miles an hour the whole way. Both of those might get you there. But if you get off the highway, every time you see storm clouds start to emerge, it's just going to take you a lot longer to get there. And I think that's just helpful context with regards to being involved in the market and staying invested in the market. There are going to be storm clouds, and keep in mind that behind the scenes, myself and the rest of my investment committee are staying very close to market developments, and you very likely may see changes made over the course of the coming weeks and months as information develops. But again, I'll just reiterate that what you should do from here is very much a personal decision. It's individualized, and I would highly encourage you to maintain a dialogue with your advisor. Whatever you need from them, we are very much here for you and here to help. And you know, stay in touch, and you know, just be open to a dialogue, and we'll help you address any concerns that you may or may not have at this time. Matt, anything else to add before I start to address some questions that have come in?
No, I know, you know, I think that's great. I mean, at the end of the day, you know, sometimes not reacting is the best course of action. And, you know, we know that, you know, these swings can be dramatic, and we feel them, and being down, you know, the market being down 10% in 2 days is never good. However, you know, a lot of this can be short-term trading activity, and it's very tough to react to, despite you wanting to react to. Focusing on the long term, keeping that long-term chart in perspective, I think is always a great strategy.
Yeah, that's well said. So we did have a couple of questions that came in, both through the inbox that we mentioned on the invite over the weekend, and then as we've been speaking. First one, I can kind of kick us off, Matt, but we had an individual talk about big tariffs on China. Are we supporting any Chinese companies by owning stocks through any of our ETF or mutual fund exposures? And what do we think of investing in Chinese companies? Are there any moral decisions to be had, or does money win out? What I would say to this, I guess just straight off the bat, is that in terms of direct Chinese exposure, we don't have any. With regards to indirect exposure through an international allocation, we have about 20 basis points technically of Chinese exposure to one company, BYD. It's an automotive
which is 20 basis points is 1/5 of a percent. So
right.
So less than a half a percent.
1/5 of a percent off of let's just call it a 5% allocation, and for somebody that's 70% equity exposure, you can do the math on that. Basically, what I'm saying is we have a very minor level of exposure there. In terms of what we think about them, if there are any moral decisions, hesitations, or otherwise, what I would say is we quite frankly don't have a firm view. What I would say is when we think about domestic versus international exposure, I will lump this answer into that conversation. We have been, I would say, meaningfully underweight international in a direct manner for the last 5+ years. Part of that is because we get so much indirect exposure through what Matt talked about earlier. The companies that we have in client portfolios, generally speaking, are large multinational firms that are sourcing revenue and profitability from around the world. So we don't feel necessarily compelled to make a specific bet on a specific country abroad or anything like that. So realistically, I think the moral decision is more of a individual by individual decision to be made. But realistically, when we step back and remove all the emotional side of things, just from a sheer investment perspective, the diversification need, for us at least, would not necessarily lead us to go pile into companies that are domiciled in any specific country outside of the US for that matter. One other one that we had flow in, is it possible to address retirement impacts with some specific recommendations for short and long-term actions? Matt, I'll let you chime in after I just kind of reiterate what I said earlier. What I would say, so let's just look at this pyramid graphic from the perspective of an individual in retirement. The same messaging really applies. Obviously, I would say that it's understandable that someone in retirement might be feeling a little bit more pressure right now in terms of maybe acting to insulate their portfolios or something of that sort. But what I would say is, to me, the immediate action, if you are feeling any semblance of unease, is you take that first step, the small action. If you have 1 year of cash expenses reserve built up, maybe you shift that out to 2 years. That at least gives you solace that over the next 2 years, you are going to be okay in terms of satisfying any necessary expenses. In all reality, if history is a guide, what we've seen in the past is that markets can and potentially in this case may recover as we work through those 2 years. And so in order to not, again, make that decision that you regret more seriously in the future, I would say that'd be a good first step, but only your advisor can help you through the intricacies of your plan, and they would know best. So this is, for any retiree, I would highly encourage a dialogue with the advisor in this kind of circumstance.
Yeah, Daniel, I'll add, a lot of that can be done with just identifying how much cash flow is needed from the portfolio, so I think that any type of small action in this regard really should be done with some thought on the greater financial plan and cash flow needs. So this isn't necessarily just raise cash and never do anything with it. It's much more proactively raising cash that's going to be needed for future and short-term and intermediate-term cash needs. So that could be feeling comfortable setting 12 months of living expenses aside. So that whatever happens over the next 12 months, you're not going to be a forced seller of stocks in a down market. Those types of things are prudent and very rational moves during volatility that would be recommended and well received. So I think that was great for retirees, people who are either thinking about retiring, retirement's around the corner. Make sure that you've allowed yourself some cushion so that when you decide to retire, if markets were to drop 20%, you're not feeling like you have to delay those plans. And same goes for the recent retirees. You know, it's nice to have a little bit of cash aside, give yourself a few months runway at the very least, that you're not going to be relying on, you know, markets going up, down, or sideways.
Yeah. We did have one more question come in that asked, is Blue Chip considering any sector shifts in light of the tariff situation at this time? I can kick this off, Matt. And what I would say is, just like we give the advice that we don't recommend any of our clients make a knee-jerk reaction after seeing some of the market action over the past few days, quite frankly, we're taking the same medicine. We are not blindly shifting into a defensive posture because of the market action that we've seen and some of the policies imposed. That certainly can change over the next few weeks and months as information develops. But what I would say is that if you look at some of our trading activity from last year, in aggregate, some of our sector allocations that got beefed up over the course of the year, like healthcare, we have also added additional exposure to the utility space. I would frame both of those as more defensive areas of the market. Those weren't because we were anticipating a trade war. Those were because some of the indicators and methods that we use internally started recommending investigation into those spaces. And we feel like we found good businesses in those spaces that happen to be a little bit more defensive in nature. What I would say is, if we won't likely be doing anything over the next week, 2 weeks, 4 weeks even, that we wouldn't have been planning on doing before April 2nd, if that makes sense. Again, this situation is so rapidly developing that that answer that I just gave may be completely different 4 weeks from now. But what I can attest to is that we'll be sure to keep everyone informed as our thinking gets updated, as we make changes, as potential changes come about, just to make sure that everyone is well informed and everyone understands not only the moves that are being made, but our rationale behind them as well.
Yeah, Daniel, last thing I'd add, you know, it's markets are volatile. There could be opportunities that pop up that we can't foresee now. So it depends, you know, a lot of what we're going to get in the short run. And if we can capitalize on it, we will. You know, we as a committee always discuss about, you know, the competition for capital in people's portfolios. You know, what we don't do is just continually add companies until we just, you know, operate like an index. We do view it as, you know, wanting to add the best businesses to the portfolio, and oftentimes when a new one comes in, something else has to go out. So what we're looking for is not just, you know, adding to potential sectors, but it's finding companies that we like more than the ones we already own that fit into the greater diversification picture. So another way of saying, you know, we're looking. Volatility can breed opportunity for us. You know, things that were overvalued can become undervalued, and vice versa. And those are things that we're continually look for from the committee standpoint.
Yeah, great call out, Matt. So I'm not seeing any other questions that have come in. So what I would say is just to reiterate, you know, everything that I said at the onset. Hopefully this provided at least some level of education around the tariff situation, what they are, how they might impact some companies both domestically and abroad. And then, you know, again, the decisions that are made right now are very much individualized in nature. So I continue to encourage a dialogue with whoever your partner at Blue Chip Partners may be. We remain very much available for any questions that you have. Just because this webinar is coming to a close, that doesn't mean any of you aren't going to have access to me directly as well. Whether it's via a phone call or an email or whatever your preferred medium is, don't be a stranger. Get in touch with us. We're happy to chime in on any potential issues you're having or any questions you have for that matter. And so on behalf of Matt and myself, thank you so much for joining. We really appreciate you all taking time out of your busy days. Hope you enjoyed it, and we look forward to talking with you soon.